Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Well, it's Tuesday. We got some stuff going on here. Hold on. My some of my stuff here is not set up correctly. I'm gonna say we do have some news here, don't we? No, actually, we don't have anything at the bottom of the hour. I thought we had. Oh, that's not until 8 o'clock. We have U.S. JOLTS today, which is kind of weird to have it on a Tuesday. But yeah, that's going to happen. That's a pretty big thing. So we'll see how the market behaves until then. Right now, though, they are starting to trend back down again. So let's check the charts and see where we're at relative to yesterday. Okay, so I take it that the German CPI was not good. Let's see here. German CPI month over month preliminary 2.2. That's in line. Well, I don't know. So I'm not 100% sure why they're selling, but they're pretty strong downtrend here. All right. S&P 500 kind of following along, not as extreme of a sell as I would think given the change in interest rates, but it is moving down in correlation. But oil is not. Okay, I'm getting some reports that oil could be demand constrained from here. So it's still kind of like, I don't know if they can really get back to like 100, for instance. Okay, but oil continuing to move up here while we're getting a larger inflation scare. Not good. Not good for the economy, right? Gold and silver. Okay, gold and silver got hit pretty hard. They were rallying really early in the morning and they got hit by the increase in interest rates. But they are holding up there relatively well. So gold and silver are behaving differently than they did in past inflation scares. They are more of a flight to safety asset. That's a pretty major change in the market. Copper's doing okay this morning as well. Japanese yen continues to just be in the doldrums, man. So if the Japanese yen starts moving up, that could be even more carnage in the market. So maybe it's a good thing that the Japanese yen is relatively mild and uninteresting right now. And then Bitcoin struggling a little bit. You can see here they had a little bit of a down move. We're pushing back towards 6,500. There are some prices down below us, although I'd say it's down below 60,000 where things get a little bit scary in Bitcoin. But I think we're a long ways out from there. So we're coming back over here. So Uzi says yields just bleeding up. Well, we are 8 basis points higher than we were yesterday. That's pretty significant, right? Like anything more than 5 basis points is a relatively major move, with like 20 basis points being some of the largest moves I've ever seen. So yeah, this is a significant change in the market. Like yesterday we saw a real inflection point for sure, and seeing the market kind of continue some of that trend here this morning, I think is a really, really big warning sign. And definitely, I would prefer to be short today. What price though, man? Because like, this is like, look at this trend on just like my 1 minute chart. Okay, you did get like a 6-tick pullback, but like, good grief, it's just been down all night. Is it gonna turn around here? Is this where I try and go? Oh my gosh. So they just, when they tick down, that offer is following it so closely. Okay, but they did just buy out that offer right there. Do you think that they can buy out that 5K at 18.5 though? I'm definitely feeling some FOMO this morning, right? I want to take some live trades. I still feel like I need the right, setup. Like, I really don't want to get in on something that has already gone so far. I really should be taking more live trades than I have been, though. So let's stay vigilant today. Well, let's make sure that we come in and put our notes. Let's do our notes. Bring the keyboard over here center so that I can type super well. Okay. So, flows today. Strong inflation fears sentiments. When we come back over here to the charts, can we consider this like in momentum now? Oh, we need to come to a daily chart. Yes. New, let's say, multi-month lows / momentum. Okay. And then we have jolts. Eight o'clock. MST. It is a Tuesday. I don't know if I should really note that it's a Tuesday on here, but that's really a big deal. Is there anything else on the schedule? There are a lot of Fed speakers later in the day. Let's check and see what they are. Williams will be speaking at a moderated discussion at the Economic Club of New York with audience questions expected. That will be pretty significant. Messer due to speak about the economic outlook at Cleveland Association for Business Economics. Audience questions expected. And Daly due to participate at a fireside chat at Las Vegas Chamber of Commerce, and audience questions are expected there as well. So let's put in Fed, well, let's say FOMC member speakers. Or just FOMC. Multiple FOMC later in the session. Oh, geez. Yeah, that uptick, I guess, was just another opportunity to sell it because they could not get through that offer at all, and they are now 2 ticks lower. Okay, so all of this, I think, strongly points to going short, especially these first two. Jolts, well, I kind of suspect that Jolts will, well, I don't know. That Jolts is a really hard one to predict. Jolts is a really hard one. And the FOMC speakers, I don't know what they'll say. Will they start to be more hawkish? I think that since the market is already kind of selling, they don't really need to be too hawkish. Yikes. I don't know. Okay, but that does give me, I'm going to say a tepid sell. I'm not going to say like super strong conviction sell, but a tepid sell for sure. And if it's a tepid sell, that also means that I do want to get relatively good spot on it. Because there is a real risk that this starts to curl back on itself during our session. Especially with that much downtrend overnight. Even at 17 there. Like we were at 110.16 yesterday, right? There's 16, 109.16. And that almost puts our yield at 4.4. This really is a yikes. You were short from 17. Good job. I really think that in this situation, all I can do is watch, because this is a really quite an extreme sell. It's always so interesting when the market makes a shift like that, you know? Because it just, the sentiment changes so quickly, and what you see is just the exact opposite of what you were seeing before, you know? Because last week it was just, you couldn't hit this market down. They didn't care about inflation. You just couldn't get them to do it. And you know, we're thinking treasury yields should maybe be a little bit higher, but the market just did not care. And now it's just everybody wants to sell it, and it just goes down and down and down and down and down. Good morning, Meishan. Okay. So that was probably the most significant, like, 2 ticks up we've had since the session started. The top story on r/politics is Joe Biden's economy is honestly pretty amazing. How come he doesn't get cut of pan? The media is trying so hard with this one. And it's, you know, in the beginning it was kind of like people were discussing it, yada, yada, yada. But now you go into the comments and like everybody knows. It's like, yeah, because the number that you're talking about doesn't matter to everyday people. Nobody can afford a home. They don't care about the rest. Yeah, okay. Companies are doing well, but why should I care if I can't get a house? You know, I have a house. I'm lucky. I was already in one. But if I had to buy a house right now, I would be so upset. I would be paying like more than double what I pay for my house. It's just absolutely crazy. And then you turn around and you want people to be optimistic about the economy? Yeah, this is not going to happen. It's not going to happen. Doesn't matter how many stories you put out. Off topic, but since you're systems guy, this is pretty nuts. Oh yeah, so I haven't watched that specific video. I was actually had it on my list because I've been watching the Primogen lately. But I spent a pretty significant amount of time yesterday you know, checking all of my systems to make sure that wasn't a problem. Luckily, most of the distributions out there that were like stable release did not actually have it. So my Arch systems, they had it, so I needed to update those. And they already had, Arch already had the update in there. But this is a big deal. This, you know, Brad, this is not off topic. This is very much down our alley, because this is really interesting. And it just keeps selling too, man. I'm like overloaded today here, man. This is crazy. I'm not going to take a trade. This could keep going. This could move down like 16 ticks from now. I'm not going to trade it. I really want to go short. It's going down like it's all in line, but it's already too far. It's too far, and I just can't justify jumping on board. Okay, so here's what's going on for the uninitiated. There is a library called XZ, and this library is used by many other open source applications for like a compression algorithm. And this library was basically creating a backdoor. It was creating a backdoor so that they could remotely log into your system and do whatever they wanted, essentially. So there's this engineer at Microsoft noticed that his logins were taking half a second longer than before, and then went in and looked and traced it down to a change in the performance of that library, and that's how he discovered the backdoor. So how did the backdoor get in there? Well, somebody went and started contributing to that project, became like a valued contributor and a trusted contributor, and then after 2 years, then he put the backdoor in. So this was like a hack that was 2 years in the making, and he was able to put a backdoor in there that would have affected basically everybody. Like, it's really crazy how nasty of a backdoor this was. And of course, the next question that everybody has is, well, how many backdoors are there out there like this that we haven't caught? Because we were just kind of lucky that there was a Microsoft engineer autistic enough to notice, right? So now that everybody's out there looking for it, maybe we will find some more. So this is a big concern to me. I'm not like losing sleep over it, but I'm super concerned about it. And I think there are so many different avenues of discussion after that about what to do about this. From one hand, this is really going to change the open source community, because right now they already have a hard time like finding people to maintain some of these projects that everybody's dependent on. You don't really get any thanks for it. A lot of developers are burning out. They were already talking about that. And, you know, now we're realizing how important and how dependent we are on these guys. I hear. Is the background music on here? Yeah. There was a time where we didn't use it, but we switched, and I think it's edited. Anyways, you know, it's kind of curious when you think about it from an economic perspective, because people will say, well, if people are, you know, there's not enough people to go and maintain these open source projects, that just means that the companies that are using these libraries in their products need to start paying. They need to start paying the open source developers to encourage them to contribute and so forth, right? But the issue is I don't know if the demand is there that people will pay for it. And so we actually have a very interesting conundrum, an interesting economic conundrum in the software space. Because the reality is that the amount of programming that probably should be done is significantly more than the supply, the amount of developers out there to write code. And especially the amount of developers out there to write code and not be paid for it. Right? We've been relying on the goodwill. So everybody says like, oh, software programmers are it's oversaturated and that's not going to be a good place to go anymore. And then I look at this and I'm like, yeah, but look at all of the work that there is out there to do, right? Like the reality is that the work that we need done is more then the amount of capital that we have to put in it is really what it comes down to. How do you resolve that sort of thing? And then on top of that, it's like, which open source projects should really be given the money? Like let's just say that I somehow was able to procure $1 trillion from Congress to put into software projects. Which ones do I put it into? But which people do I allow to contribute to the software projects? Who should be trusted, etc., etc., etc. These are problems that are so complicated because there's so much information. The only way that you can solve a problem like this that I know of is a market. And again, the capital for this market just doesn't exist. So what are you going to do? And like, I guess in the end, probably the money will need to come some way, because this current situation is, we are so open to a cyber attack from another country. If if there was a open conflict with Russia, for instance, or China, and the hackers got involved, it would be crazy, dude. Maybe we need more hackers. Missed yesterday, unfortunately. Watched a bit of the stream last night. Could you explain your back of the envelope read on what's going on with markets this week? Yeah. So here's what's going on. Kind of lay a little bit more context here. Look, almost everything that we've lost. Oh, no. When we opened, we were at 20. Okay, but we've retraced about half. Okay, so last week was the end of the month and the end of the quarter. So that's an important factor in all of this. Why is that an important factor in all of this? Well, because these funds, they have to rebalance. They have to maintain a 60-40 portfolio usually, or pension funds have to maintain a certain split. So if their equities go up, that makes the equities a larger part of their portfolio. They're going to have to sell the equities and buy the treasuries. Okay. So if you were somebody that for some reason last week, you all of a sudden got a really strong opinion that interest rates are too low, inflation is going to reaccelerate, and you want to sell treasuries. Last week was like the worst time to do it, because those flows from those pension funds are so strong, it's going to move things up. So what do? You wait for them to finish, and then you go short. Okay, so that's the first factor. And then we got PMI. Okay, so what is PMI? PMI is Purchasing Managers Index. There are 3 different companies that do PMI numbers. The S&P Global does one, ISM does one, and Market does one. But the ISM PMI is particularly important because it is like the most leading. It is like the most up to date. Like the one that you get from the S&P, that's like last month's data. Whereas the one that you get from ISM is like this week's data. This is like what purchasing managers are saying right now. And what they do is they call companies up. They have all of these contacts that they know. These are people that they say, okay, we're going to be building X of these things, so we need to buy this much supplies, right? That's what these guys do. So the purchasing manager indexes are the most forward-looking indicator. Let's not say the, but one of the most forward-looking economic indicators that we have. So it's super, super important. It's a leading indicator. That and like money supply are 2 of the most important things to look at when you're trying to figure out what the macroeconomic picture is. Okay. So what happened? Well, we got those numbers yesterday, and all of the data in the PMI suggested that prices are starting to go up again. And that this time it's a little bit more supply driven. which is to say that the cost of materials is going up and the cost of manufacturing is going up, and so they are passing off those price increases to consumers. It's kind of funny, actually, when you think about it, because during this whole time, what we've had is essentially a demand-driven inflation problem. We gave people too much money, and it went directly into consumption, okay? Yeah, I understand this. Like, we make money. Like, when you go to a bank and you take out a loan, okay, the bank is literally making money out of thin air. All the bank does is they buy and sell securities. So, like, when you make a deposit with them, what they do is that they write this little contract, and then they buy that contract from you, and that's what bank deposits actually are. Okay, when they make a loan to you, it's the same thing. You are basically buying this thing from them, and that's money that you get to pay for. Anyways, so they are making money. We made too much money, but the question is not just how much money we are printing. Okay, this is the mistake that I see so many people on the internet make. Is they say the amount of money, the money supply should be directly related to like how much inflation we get. Not true, because it matters where that money goes. So if that money goes into productive uses, like it's used to help people build businesses and conduct more business and grow, then that effect tends to be very, very positive. You get very good economic growth. You get relatively low income disparity and low inflation, actually, when this is done well, when it goes into productive uses. But if it doesn't go into productive uses, what that means is it's going into consumption and into financial transactions, then the price of things will necessarily go up. Okay? Now, that's what's been going on. There was demand, and then we had so much demand that it created supply problems. So some people tried to blame it all on the supply problems, but I don't think you would have gotten the supply problems if it was not for all of the money that they printed to begin with. But I digress. So when this happened, the Democrat Party in particular, I'm going to be a little political here for a second, but this is just objectively what's been happening, is the Democrat Party has been spending all of this time trying to convince us that this inflation was not their fault. It was not the fault of government. It's the fault of corporations. So corporations are making all this money from the inflation and that they're causing it. Well, in a roundabout way, I suppose you could say that companies caused it because companies did increase their prices. But why did they do that? They did that in response to the demand that they were getting. They were responding to the economic conditions that were created by political actions, right? The argument is, well, corporations could decide to just not increase prices. Well, they could, but they would suffer for it. It would hurt the companies, and you would have more supply shortages because people will just buy everything out if the prices don't increase. You just run out of everything. Okay. So they've spent all this time talking about that, and now all of a sudden it looks like we're getting the opposite. We're getting something where it is like everything down the chain, the supply-driven inflation is coming and turning around and increasing now. So now what are they going to say? What are they going to do about that one? If that's really what's going on. Okay. But so that's what happened yesterday. Now, with the way that it was like right from the get-go for the first 90 minutes of the session, they were selling it really hard. Kind of suggests to me that somebody knew what the ISM number was going to be, which, you would have to, I don't know how you front run that one. I don't know how you have the inside track and know what that's going to be, but it seems like somebody did because they sold it really hard. And then after it sold, after the news came out, it just kept going and going and going. And so the market has had a complete shift. It has had a complete shift from, Inflation is under control, everything's hunky-dory, and the Federal Reserve is going to cut interest rates 3 times this year, to, oh no, inflation is still a big deal. The Federal Reserve isn't going to cut interest rates at all this year, right? There's a complete shift in the expectations of the market, and so you get a really massive swing. And now, already, we are now in like momentum areas. That right there is a signal short on a lot of momentum strategies. So of course, every momentum strategy has different triggers, but one trigger that's used a lot is a new 90-day low, right? We haven't been this low since December, essentially, right? So this is like a 3-month low. And our 50-day moving average is below both the 100 and 200-day moving average. So it is a short on momentum. So now everybody and their dog is coming in and shorting the treasuries. When before they were kind of buying them, if not kind of sideways. Now, on top of that, the S&P 500 is kind of a little nonchalant about it. The S&P 500, yeah, they sold, but like, it's just an average move. It's just an average move. Compared to what the treasuries are doing, big moves. Big moves. So, because of that, I think that we could continue to see a little bit of carnage in the equity markets. Okay, so that was like a long spill. I took a couple of detours there, but I feel like that should give you a really, really strong base to understand the action that we're seeing here today. Well, it looks like I did the right thing by not participating in that sell, right? Because it wasn't until 18.5 that I could have sold. It went down and it came right back up. There's this thing where, you know, you get all of the day traders and the robots and everything, and a lot of that is like mean reversion trading. So if I'm seeing it like it's just going down overnight, and it's trading down pretty strongly at the open, I've got to be worried about a reversal. I've got to be worried about a reversal. Because even if the flows continue to be mildly short, you get such a liquidity hole and all this other stuff that it just gets sucked back up there. So yeah. Now we could maybe take a trade, but the trade that will be available to us now will be a little bit tougher, right? Like I could try taking a tick out here on a sim. Over here in the micros. 4383 isn't bad. Volume profile wise. I think I'd rather get 438 though. Oh, I missed part of Dylan's comment. I wouldn't expect bonds and the indexes to sell off like that together. Okay, yes. Because the correlation between equities and treasuries changes. Sometimes it's positive and sometimes it's negative. And it depends on the story that is driving things, right? If the story that is driving things is that the market is anticipating a change in money supply, essentially, then they tend to go together. Okay. Whereas when the change that is anticipated is more like anticipation in the or expectations in future economic progress. The classic setup is, hey, we're about to go into a recession. Okay, like for instance, if there was if there was a nuclear attack, okay, if there was a nuclear attack, I would expect the equity indexes to sell off really hard and the treasuries to buy really hard. They would have opposite correlation. They would have negative correlation, right? Conversely, if some crazy discovery happened, like OpenAI came out today and announced that they have indeed created a general artificial intelligence, then I bet you that the equities would rally and the treasuries would sell, right? When it's the economics that are driving it, they tend to be opposite correlated. When it's the money supply that's driving it, they tend to be positively correlated. You need to stop saying opposite, I say negative, but you know, maybe you don't know what negative correlation is, right? No recession, everything is perfect. Praise be to the exalted general. You know, I do kind of wonder about the conundrum that we're kind of in when it comes to money policy, right? Because we have too much debt, and the interest rates that we have right now, you know, how does that work? The government is going to spend so much money just paying interest on the debt. And you realize that where does this money come from? They just print it out of thin air. So it kind of weakens the currency, right? It's just, I don't know how that works out. So how do you fix that problem? Well, you could stop spending so much money and reduce the deficit. Yes, you could, but that will mean less money out in the economy. So that's austerity. That tends to dampen economic activity, right? And hopefully the amount that it dampens economic activity is hurts less than the benefit of reducing the deficit, right? European countries went through that for a while, and it wasn't going very well for them. Then the split side is you need to cut interest rates, right? Okay, you need to cut interest rates. You'll need a weaker economy to do that. But then if you're having a weaker economy, that means that we're going into recession, which means that you're probably going to have to start spending more money to get out of the recession again, right? So I'm not sure. Essentially, for this to work out, Congress needs to not do austerity, but just get the budget under control. And then we need to have another really strong period of just slow and steady growth. And the interest rates maybe come down a little bit. That's the soft landing scenario. When you look at it from that perspective, now you kind of see, was all of the talk about the soft landing because the soft landing really was so likely? Or was it because we needed the soft landing to happen? And I kind of tend to feel like that it's the latter. I've noticed that people in general and the markets and even the people at the Federal Reserve have this tendency to lean into the optimal scenario, right? Which is why when the optimal scenario doesn't happen and it surprises them, that they're left so off balance. And that's what you're seeing the past 2 days. Markets off balance. Because it's just gone from, we're going to get a soft landing to hold up. This isn't even done yet. We pay more on interest in a year than we do for our military, which is obscene. Well, it is obscene, but it also kind of, puts into perspective how big the budget really is. Like, it's really wild because Medicare and Social Security are the largest parts of the budget and pretty much dwarf everything else. They pretty much dwarf everything else. And then the only other category that we have after that that's major that you can really make significant cuts to is the military. So having interest payments be more than the military, I think it's a little bit more complicated than that, but for a second, we'll just run with it. Yeah, this is pretty significant. The government kind of does need the rates to go down. But you know, remember having this in 2021, 2022. Can you believe that it is 2024 now already? But good grief. I remember arguing with the internet about this like every day. Every day I'd go on TikTok and they're like, no, the Federal Reserve can't raise interest rates because then it would be too expensive for them to maintain the debt. Well, that's not their problem. That's not the Federal Reserve's problem necessarily. That's Congress's problem. So guess what? The interest rates went up. Now you got the problem. If only we had just said, hey, you know what? We've done enough stimulus. We don't need to do too much stimulus. Okay? If only the politicians had known that, hey, when we create money through fiscal policy, we need to ensure that that money goes into productive use cases. So we shouldn't do things like give money directly to consumers to encourage people to buy things, increase aggregate demand, right? Then we wouldn't be in this conundrum. But it happened, and now you're stuck. And now what do? You just stay in that situation until it blows up? Maybe that's the only way. Can you explain a little bit more about what you mean by when the money supply is driving things? So in this context, I'm using the money supply to kind of explain a whole host of things that have to do with the availability of money. Okay. So this is the dirty secret. Is it the dirty secret? I don't know. Like the thing is that I don't think that anybody's trying to keep it a secret, but it just seems to me like the public is so uninformed about how things actually work that even when we're trying to tell them how it actually works, they misunderstand it. It's a really kind of a weird thing. And this is what I would consider what I'm about to teach you. Well, and I've already kind of taught you, but I'm going to try and teach a little bit more explicitly here. What I'm going to teach you is what I would consider a luxury knowledge, which is to say, how sophisticated your answer to this will tell other people as a great deal about what economic class you are in. Okay, because the upper class people totally understand this. Okay, we just make money out of thin air, right? You personally, well, in a roundabout way, kind of, you personally can print money. Don't have enough money, you can print it. You go to the bank, you say, I need a bank loan. They make the money. And when the bank makes the money, we all think that like banks take deposits and then they use those deposits that people put in and they go and they loan them to other people. Okay. There's been many studies about this now. I can go and I have on a list, actually. This is one of my saved sources. Okay. But they've basically proven this empirically now, and they've also kind of proven it from like the standpoint of law. Okay, the banks, they just make the money. They don't go and take out their deposits or anything like that. They just more money there. Okay, now how much money they can make is constrained by certain factors. Okay, for instance, they used to have a reserve requirement. They still don't have one, but there used to be a reserve requirement where the amount of money that they could create could only be 10 times larger than the amount of money that they were taking back out of the system. Okay. So what that means is when you go and you get a loan from the bank is fronting that money out of thin air and giving it to you. And then when you pay that loan back, okay, that's just taking money out of the system. When you pay that loan back, that money just gets destroyed. That's where it ends. So like, I could take a loan, I use that money to pay for this thing, and then that money gets transferred over to this other person. And that money will just bounce around the economy. And how much it's bouncing around, that's called velocity. Okay, money velocity. Until eventually, somebody will pay back a loan, and then that money is taken out of the system. Okay? Now, we can control that money creation process. And those are the things that the Federal Reserve has control over. They can set the reserve requirements. So the more strict the reserve requirements are, the less money that the banks can make. They can set loan requirements. They can come in and they can say, in order to give somebody a loan, they need to meet these certain requirements, right? They won't give you a loan unless you prove that you have the income to pay it back. You have to be able to show what it's going to go to so that it goes into a relatively productive use case, right? And those are things that we do to ensure that the money supply is not growing faster than the amounts of goods and services that are actually being produced by the economy. Because when the money supply gets bigger than the goods and supplies being created by the economy, then you get inflation. Yeah. They also can control this through the interest rates, okay? Because the interest rate is kind of ends up being a little bit like a speed limit or a governor that moderates the activity that the bank can do, because that's a cost that they have to pay. They have to pay the interest back. And so the more interest that they have to pay, the less loans that they can make. Okay, so raising interest rates also constrains the creation of money by the banks. And that is how we control the money supply. Okay, so any of those changes that we talked about, reserve requirements, lending requirements, interest rates, I would also put on there's let's just say interest rates in general, but there's also this kind of more complicated thing about at what price they will do certain operations relative to the rent. Anyways, I don't even remember the word for it now. Okay. So generally speaking, when we make changes to these things, what will happen is money supply will go up. And this is expressed, there is an economic number that gets regularly published called M2. M2 money supply. And M2 money supply is one of the most leading indicators in the economy. When M2 is going up, you will tend to see the economy get bigger. And when M2 is going down, you will on net see the economy get smaller. Over the past few years, it's kind of been going down / sideways. Okay. And that's why you saw, the kind of bear market that we saw in 2021 and all of these things. Okay. But the Federal Reserve isn't the only one that controls these things. Okay. Congress can also essentially make money. Right? Why is that? Well, because Congress can spend, and there's no requirement that says that what Congress is spending is money that we've already taken in from taxes. Okay. So when you pay a loan back, that takes money out of the system. When you pay taxes, that also takes money out of the system. And when Congress spends money and it spends more than it is taking in taxes, that is essentially putting more money out there. It increases the amount of M2 money that's out there. Right? It's just it's coming through a different avenue, right? Instead of it coming from the banks creating loans to people, it's coming from Congress essentially giving money to companies, debt or whatever it is, whatever have you, right? Congress continues to spend, and so there's a lot of that money that's been out there, and that's kind of why the money supply has been going the way that it is, right? Like student loans. So when they don't require you to pay back your student loans, right? That's money that would have come out of the system that's not. It increases the amount of aggregate money in the economy. Increases the amount of M.2 out there. Okay. So when I say money supply, that's what I'm talking about. And when that happens, when you get those changes, the markets respond to that. And it just so happens that the way that equities and treasuries respond to that is the same, essentially. More money that they create, the lower they want interest rates to be. So you'll see treasuries buy and you'll see equities buy because they expect that more money will come in and create more economic activity and they'll be able to get more of it. Yeah. There's a dearth of good info on macroeconomic correlations as it pertains to day trading or just generally understanding markets. I agree. Well, so part of it is you do have to get in with the right crowd, right? There are products and services that focus very heavily on macroeconomics, right? And there are sources and so forth out there focus very heavily on monetary policy. So what I'm sharing with you is just knowledge that I've picked up from a cacophony of sources, including working at the bank. I mean, this is the like, again, it's luxury knowledge. If you worked at a bank, you kind of understand this, right? It's kind of funny because the bankers always understood this without actually understanding it. Like if you had asked 30 years ago how this works, they would almost certainly have explained to you like what fractional reserve banking is and all of that sort of stuff, right? But they kind of knew how it worked based on their own experience with it, right? But it wasn't like they didn't explicitly. It was almost like this double think going on in their head until these people in economics and these professors and stuff started like doing studies on it and proved that actually it is. Like the banks literally create the money. Now what you see is, I think it's generally understood in the banking world and among the upper class, but I constantly see political people out there that I believe are intentionally taking advantage of the public being misinformed about this, right? They very much are doing that with the student loan issue. Like, student loans is a transfer of money from these people that were supposed to pay the loans back to now taxpayers pay for it, right? But does that mean that like your taxes are going up? No. What it means is that there's more money out there available and you get more inflation. That's the net impact. Student loan forgiveness increases inflation. Straight up. That is money that would have come back out of the economy that stays out there. And then that means that there's certain fiscal policy and monetary policy that you can't do now because there's too much money in the system. That's the net impact. Now, when it comes down to correlations, there's one more layer to this that you got to understand, right? By and large, most of what you're seeing has more to do with what people think is going to happen more than like the actual reality. You're trying to predict what other people will do. Because there is ultimately kind of like a safety on this, right? If the Federal Reserve is going to raise interest rates, they're going to raise interest rates. So it doesn't matter what the market thinks about it right now. What matters, I mean, that's going to move the market right now, and that's going to be really strong. But eventually, they will have to face the music because the Federal Reserve will always beat them, right? So you have to consider that into correlations. And so there can be, it's where it gets really complicated in particular is when it comes to like, what is the dollar going to do, right? Sometimes the way that the dollar reacts to these sorts of things doesn't make any sense, but you just have to realize, what are people going to do, right? Like, is the thing that just happened going to make foreign countries want to bring more money to the United States or less money to the United States? And that's going to affect the price of the dollar. That's how you sort those sorts of things out. Now, so for instance, a correlation with the dollar that we will see with the treasuries that we want to pay attention to is the higher the interest rates are, the more money you make holding treasuries. Ergo, the more dollars you want to hold. Because that's what the countries do, is they say, okay, I have all of this cash. I need to put it into something that yields money. I want to, so, hey, the U.S. Treasury, they're giving pretty good yield. So let's go and put it into U.S. Treasuries. And so they convert their currency into dollars, and then they use those dollars to buy treasuries. Okay, so when the treasuries go down and the interest rates go up, generally speaking, it makes your currency stronger. It makes the dollar go up. Now, is that what we're seeing today? Well, kind of. It was what we saw yesterday, right? Treasury yields went up. Treasury prices sold, treasuries sold, dollar goes up. Okay. Now here this morning, yields went up even more, but the dollar is actually kind of falling. Another thing that you could see, for instance, is like, what are the yields relative to other countries? So if the dollar is staying, or if the treasury yields are staying relatively high, but the Eurozone is cutting rates, which is what it kind of looks like is going to happen, because in Europe, they're already cutting rates, and all of a sudden the market is starting to think maybe the US can't cut rates, right? That also means people will want to have dollars and come over here and buy the treasuries. So that could be a situation when you get something like that. Okay, if let's say at the next ECB meeting they cut rates and all of the speak is very, very dovish, you might see treasuries over here in the US buy. Because they want to get out of Euro bonds and they want to get into US bonds. And so then you might see the dollar go up and the treasuries go up at the same time, right? And then they would be positively correlated. Seems like kind of the same situation, but it's not. And it has to do with, what are people actually going to do with individual assets? Are they buying the treasuries because the yields are going higher? Then that's when you see the opposite correlation. Or are they buying the bonds because a relative valuation to somebody else? Then these yields over here in the US aren't necessarily going up, but they're buying the treasuries, and that actually will cause yields to go down a little bit. So that dollar bond correlation can be super confusing. And the thing is that like every macroeconomic situation that happens kind of ends up being unique. So, you know, we can try and guess, but it's very often wrong on those sorts of things. Very often end up being wrong on those sorts of things. And then even more complicated is, and this is the one that I don't get at all necessarily. I understand that the US kind of exports its inflation abroad, and that this has negatively impacted other countries that don't have a whole lot of pricing power. But I don't completely understand the mechanics of all of that or predicting it. When the treasuries started selling off super, super hard, I was a little bit surprised by how much dollar strength came in. Because I was thinking, oh, okay, they're printing too much money. Inflation is a problem. If inflation is a problem, shouldn't the value of the dollar go down? How can you have high inflation and high value of the dollar at the same time? It doesn't make any sense. But that's what happened. That's what happened because the yield's going down. The treasury is going down and the yield's going up caused the value of the dollar to go up, even though your dollar wasn't buying as much. Essentially, the dollar went up, but the cost of goods went up even more than the dollar did, right? Yeah, so I heard someone say that the dollar is remaining strong because other countries want it strong because they're in bad shape. No. This is why I keep coming back to it every morning when I'm doing this, kind of like going through and seeing where we're at on the various instruments. When I come in and I look at the Japanese yen, right? Because the yen and the dollar have kind of been opposite correlated. If the Japanese yen strengthened considerably, you probably would see the dollar fall. Now, the dollar falling is often good for equities, so that would be generally okay for equities. But it would also make US bonds less attractive yet relative to Japanese bonds. Right now, it's not a big deal. But the way that the market is going to react to that, generally speaking, is or the fear is, at least. I'm not saying this is what I think would happen, but I think the fear is that you would see the Japanese yen spike up, but the treasuries over here in the US stay the same or fall. So if the treasuries fell and the Japanese yen was moving up, that would probably be a little harmful for the market. If the Japanese yen came in and moved up, and the treasuries moved up, which is what has happened when they've done intervention in the past, then that's probably good for the market overall. It's been a long time since we've had some drama in the VIX index. Yeah, well, it was overdue, wasn't it? So we pulled that up. Now would be a good time to get into some charts here, because the S&P did open just now. I never heard the click or the ding that we started, but okay, they're selling off at the open. What is DJT doing today? Buy on open. Okay. I kind of find the action in DJT yesterday a little suspicious, this down move here. Because there was like a warning that they had a cash crunch or something like that. All of the stories that I read on it were a little bit vague, so I don't know if that was, it kind of felt like that was like old information. But, oh my gosh, on Reddit, saw so many stories on Reddit about this company. And I find it a little suspicious. So I do kind of, I think I would rather be on the short side on this, but there's no way that I would do it, because the chances that these are like all shorts that are going to get squeezed is too high. Too high. That one's interesting. But what we came over here to look at was the VIX. Now we need to go to like a daily chart, probably. Right. VIX is so low. It's coming up. Well, it has a long way to go before it's really that interesting in the VIX. Before we're getting like a real spike in the VIX. Seth, is the bookmap DOM any good? I would say that it is sufficient. I don't think that it's as good as the Jigsaw DOM, but it gets the job done as I understand. But I haven't really used book, and I'm not sure I've ever used bookmap. Have I? No, I think I have installed it on my system and taken it for trial, but I haven't really used it a whole lot. Most of what I know about bookmap is from watching other videos. But it gets the job done. Jigsaw to Sierra DOMs, I have. So, the Sierra, so the issue with Sierra charts is that they're kind of like copying other people's stuff, right? Like Jigsaw came up with all of the innovations. Jigsaw were the ones in particular that created the center columns here, right? Sierra chart said, hey, that's a really cool feature. We're going to copy it, right? But when they copy it, it's like, it's not quite as good. You don't get the innovations as quickly, that sort of thing. So like Sierra charts, in my opinion, is the slightly more budget option compared to Jigsaw. Like they're both, you have to pay a monthly fee with Sierra charts, right? And it's pretty close to what you're paying for Jigsaw. They combine it with their data fees and everything else, so it's kind of hard to see, but you pay $50 a month for Jigsaw and you pay like $30 a month for Sierra charts after all is said and done. But then the other big difference is that you have to pay to get Jigsaw initially, where you don't have to pay initially for Sierra charts. That's the big difference, right? Okay, so Sierra charts is the more budget version of Jigsaw. So it duplicates a lot of the features. They're just not quite as good. It's just not quite as good. But I think I would guess that probably 30% of the audience here uses Sierra chart. It is quite popular among the order flow traders because it does have all of the order flow features that you need, and it's a little bit cheaper than Jigsaw. Bookmap is depends on which package you get, but there are versions of Bookmap that are even more expensive than Jigsaw. But I'm not sure that they really add anything. That's kind of the thing with Bookmap, is I think you're paying extra for features that don't really help. Why can't Ninja make a decent DOM? I don't know. I think part of it was that Trading Technologies held a patent and Ninja was willing to pay them for the patent and Ninja wasn't. But well, but Ninja does have a static DOM and it's only in the paid one. I don't know. I don't know what the deal is with that. I do often wonder. But if I were to guess, I think that the issue is that the number of people that are out there trading primarily on order flow is orders of magnitude less than the people that are trading with charts. So it would make sense for you to put all of your effort into your charts, right? And that's probably why Ninja is the way that it is. Yep, they have a DOM, it just sucks. I would still rather enter my orders on Ninja Trader's DOM rather than like on the chart, but it's not a very good DOM. You're right. Yeah, their static DOM, when you mouse over it, it just freezes the whole thing. Yeah. Anyways, I don't know. I think that I like Jigsaw. I don't know what to tell you. I really like Jigsaw. Like everything about it. I think it looks great. It has all of the features that you need. They're constantly innovating. You get good support. You get good education too, frankly. The only downside with Jigsaw is that their charts are not very well developed yet. Their charts are still a little too new, and you can't write your own indicators. So NinjaTrader has better charts, and if I can use them together, I will. But yesterday, I went to Arby's and had their jalapeno poppers. And I'm already thinking I'm gonna be paying for that today. That's spicy. My gut is not. You know what the other thing about platforms though is that there really is not a perfect platform out there in my opinion. You know, like NinjaTrader has great charts, but there are some key things missing. That's why I created my indicator suite. Those are all things that like I need to trade. I don't understand how you're supposed to be trading in the commodity space without them. And there are some platforms that have like spreads and stuff. I don't think they're quite as good as my charts, but I digress, you know. But then they don't have the other features, like their DOM isn't very good or whatever it is. There's not a perfect platform. I guess that's kind of the advantage of having such a competitive market, right? Is that you know, you have to specialize to stand out, and so you can find a platform that matches what you're doing the best. TT probably close, maybe, but TT is way too expensive, right? I honestly, even if you were like a full-time retail trader, I'm not sure that they would want to pay the price for it still. The only people I see being able to use the TT is like a momentum fund, like a fund. Then you'd use TT. So I don't know if TT should really count in these kinds of conversations, you know? Too good for us. After reading Flash Crash, TT piqued my interest. Well, you got to realize that back then, the TT was like the only game in town. So like, I started using Jigsaw in 2016. I think that Jigsaw came out as a NinjaTrader thing sometime around like maybe after the Flash Crash. If it was before the Flash Crash, it was like not, you know, wasn't very popular yet. At that time, in fact, I could be wrong, but I remember reading like No BS day trading course. I don't think that the No BS day trading course originally had Jigsaw. You know, use Jigsaw. I think originally you had to use TT's thing until there was a cheaper option, and then he changed it. Right. So, yeah. He was almost certainly using TT. Because that was the only option. Yes. Yeah, I think that's what it was called. Yeah, is X Trader. But they kind of like consolidated it. $52.40, and then you'll go long. Okay. Well, the treasuries have kind of just been a little bit sideways. They did fall a little bit because we were at 18, 19, and we've fallen back to 16, 16 and a half. But they may have found another little bit of a bottom. We may start to see the treasuries buoyed a little bit more from here. So what I suspect. So when we came in here, the flows, strong inflation fear / sentiment, and new multi-month lows with momentum. Basically, with the amount of volume that I had seen overnight and everything, I'm kind of saying I think that all of these flows already came through. Now, in 10 minutes, we do get Jolts. And Jolts, as of late, has been a blockbuster event, so I don't know if I would be taking a trade before that. Remember that. Keep that in mind. Uh-oh. Say bad things about Trudeau and the carbon tax. You know what? I saw a lot of content pushing against the carbon tax you know, a couple of weeks ago, but now that it's like actually implemented or whatever, I haven't seen nearly as much stuff about it. Want action? EO end of month, end of quarter funds rebalancing equity bonds holding ratio. So why did they both dip so hard at the same time? That was last week. Okay, so that's why last week you were seeing equities sell off a little bit and the treasury's buying. Okay, now that those flows are over, people can take the trades that they wanted to take, and the trade that they wanted to take was short treasuries. So then you got short treasuries, interest rates are rising, and then that hurts equities because higher interest rates, less money supply, yada, yada, yada. Yeah. Yeah, and I get it. Yeah. So it's complex, right? But the whole thing is trying to predict flows, right? What are the things that we know that will lead people to be buying or selling right now? Right? Can we and can we actually like see an imbalance between them and predict an imbalance and take advantage of it? In some cases you can, yeah. We could have today if I was, you know, fast enough and aggressive enough, I suppose. But I've kind of been hands off. Maybe Jolts will give us something here, right? Browsing around here, getting what I can in before Jolts comes out. Oh, I missed this one. Brannigan Barrett, watch VIX today. I suspect it doesn't roll over like it has done all year. Could be there's been a shift. There really has been a huge shift. Then I think that you will see volatility continue to rise. What is the estimate for Jolts? They're looking for a reading of 8.73 versus a previous reading of 8.863. So they're expecting the labor market to continue to weaken. You might continue to see it worse. So if it is weaker, then that might spike everything up. That's where the correlations are the most confusing. Well, if Jolts is weaker than anticipated, that means that treasuries yields don't need to be as high. We're not as concerned about that because we're getting a weaker economy. So you'll probably see the treasuries buy, and because of those lower interest rates from that, the equities will probably recover some of their losses. So we could see a reversal here because of Jolts. Well, I guess we already technically kind of had a reversal. On the other hand, if Jolts comes out and is like much higher than expected, which we've had many times, then the market is just going to puke so hard, probably. What about gold and oil? Okay, so gold tends to be positively correlated with the treasury. So if the treasuries go down, gold goes down. and this has been quite a conundrum in the markets lately, because typically when you're getting inflation, the value of gold should go up, right? Gold has not behaved in this period the same way that it did like in the 70s. But that's because you got to remember that gold, that the supply and demand in gold is almost purely speculative. And if some of that speculation has moved over to like Bitcoin, for instance, then gold doesn't do as well as it should. And oil, oil is kind of more of an input, right? If oil is heading up, then you'll tend to see treasuries sell, and vice versa. But it's kind of a weak correlation. It only matters at certain key points. That's the only kind of relation between the two of them that I've seen. Yeah, part of it is just, I highly recommend you have something like, you have all of the key charts: copper, oil, gold, treasuries, equities. Or you have like a market analyzer like this with all of the instruments in there, and you can see which one is up the most and down the most, right? Silver is up the most today, followed by oil, and RTY is down the most. I'd say that that's somewhat consistent with a market that's concerned about inflation. And then you just watch it, and you watch the news, and you kind of see how it goes, because it's a complicated thing. It's kind of like, are there set rules? I've given you some rules, or at least rather some situations that you'll tend to see. But there is not like a matrix of equations that will give you the correct reaction based on the news, right? This is something that you'll watch. You'll watch a lot of moves, and you kind of build that machine learning network, and you just kind of know the answer, right? And sometimes you'll be wrong, but you can get pretty good at it. I think I've gotten pretty good at it. Okay, remember 8.73. 8.73 is the expectation for this JOLTS number. Stuff online can be confusing. Yeah, because they're always trying to create a system that will be perfect for you. But it's a lot better to just watch moves and see how they've gone. Okay, so 8.756. 8.756. So it was slightly higher than anticipated, and it was definitely higher than last month's. So that would be mildly negative to the treasuries, and you can see they've ticked down a little bit, but not too big. So it looks like they're saying it's close enough. U.S. factory orders month over month was 1.4% versus an expected 1%. That would also tend to push the treasuries down. Right? If factories are ordering more stuff, that's an economy that's relatively strong. But I think that what I'm reading on from here is that the flow that we're going to get from JOLTS is pretty weak. So I'm going to come in here and say inline weak flows. Okay, so now the next thing that we caught on the docket is there are going to be multiple FOMC speakers later in the session. I'm not quite sure what to expect from them, but you could get some relatively big moves later in the session. So somebody in Discord, I missed this question, it was a long time ago, but I just answered them. Somebody in Discord asked about the selling overnight. Why did ZB get hit the hardest? So if we come back over here to our chart, we can see that that's the case. So if we look at the ZB in particular and we look at the knob spread, which is the spread between the 30-year and the 10-year treasury, we can see that it is moving up, and up is steep. Up is steeper. Okay. So why is that? We're seeing a bear steepener, essentially. What they call it. The treasuries are moving down, but we're getting steeper. The bear steepener. Okay. Well, so what's happening is the market anticipates that interest rates will remain high for longer. And up until now, the market has kind of thought that these high interest rates weren't going to last for very long, that they were going to come back down. Now that they anticipate that those rates should stay higher for longer, that impacts those longer dated maturities more, right? Higher for longer, that means long dated maturities more affected. So that's why you get this steepening. They all sell, but the 30-year sells more than the others, and you get steep. Okay, seeing it at 19 after that is a little surprising. I do kind of feel like that things were oversold anyways, but I don't know. There was nothing in that news that was like positive for treasuries, I don't think. That this guy on Twitter says tech has 3 jokes. Stack Overflow is mean, JavaScript is bad, and dark mode is good. My life's goal is to discover a 4th joke. And then later he said, my apologies, quitting Vim is the 4th joke. As all 4 tech jokes have now been discovered, I will be closing this account. Goodbye. I will never quit. I will never quit Vim. You can pry it from my cold, dead hands. That's wrong. There are 1-0 jokes only. Haha, I see what you did there. Why hasn't anybody come up with a joke about quitting Emacs? Because no one ever starts Emacs. That's it. Yeah. Well, I didn't like Morgan's long 5240 before because, you know, we had news coming up. But now it's looking pretty good. Are we going to bust the high here? What could that bring? Tough for me to say. The Japanese yen seemed to react a little bit more strongly to that jolts. The dollar react pretty strongly to that jolts. Yeah, there's a really big order of 5232 that's been there for pretty much the whole session, actually. I'm not sure I would read too much into that. I don't know what... Maybe there's some key technical level there, but I don't see what it is. Oh man. I don't know why I'm reading Reddit right now. I'm not so interested in this. I probably should be more interested in the treasury here than I am, but I'm not gonna make a bet that it's gonna break that high. The issue is that I think that the flow should still be mildly negative. It's just like some of that is over. Does that really give me a strong reason to buy? I mean, it could go up, but I don't think it gives me a strong reason. I don't expect the flows to turn very strongly positive. And so if there is some upside to be made in treasuries, at least, I think that it's kind of limited. In equities, it might be a little bit better risk reward, but we'll see. We'll see if the equities actually pull it out here. They're still kind of struggling. They're still kind of down towards the bottom range. So I'm reading Reddit. Here's a thread that's too much, I think. If the bombing of Hiroshima and Nagasaki was a moral evil, that's questionable, but okay. Then so was the bombing of Dresden. Yeah. See, I have the opposite. I think that the use of the atomic bomb was okay, but I'm not so sure about the bombing of Dresden, if that should have. Your long doesn't seem to be working. Oh, you got 52.48. I don't know. Oh, 52.48 wasn't the best price, was it? Well, that's where, when I look, I mean, I'm not saying use the volume profile to do this, but in this situation is just a good illustration of where we're at, right? If I have a liquidity hole right here, and we're going back and forth, right? If I insist on taking a long within the liquidity hole, I would prefer to get it towards the bottom of it. So I would prefer to be long 52.40. rather than be long 52.47, because now I'm at the top of the range, and well, you get exactly what's going on right now, right? So it continues to chop, and you have to sit through the heat. I'm not sure if this area down here would qualify as a liquidity hole or not. It's kind of tough in equities though, right? But, you know, if you can identify a range, you definitely in your favor to buy the bottom of that range or sell the high of that range. Doesn't tell you anything about whether the trade is more likely to go up or down, but you definitely do better. You know, if it does go up and you bought the bottom of the range, you're going to do better. And if you bought at the bottom of the range and you're wrong and it goes out, you're going to lose less. Well, it would be interesting if they do go for that 52.32. Oh boy, okay. From r/investing, this guy claims AI will ruin entire investing strategies. Let's see what he says and why he's probably wrong. In 1998, the SEC authorized electronic exchanges. At that exact moment, high-frequency algorithmic trading was born. This completely changed traditional trading forever, as everyone here knows. That is true. It pretty much ruined market making because you couldn't compete with the robots. Everyone here who is doing TA is effectively competing against hedge funds, trading firms, etc. that hired former MIT math Olympiads to deploy quant models to pattern recognize better than any simple bot you'll find on a GitHub scan. That is obvious. I'm not making this post to talk about chart analysis, but rather I think we're going to see a similar shift happen that we saw in 1998, and it will happen that impacts the traditional finance markets. The first firms to benefit from high-frequency trading, algorithmic trading bots, and quantitative models had a disproportionate advantage over the general population. Advancements in neural networks are about to make the gap wider than we've ever seen. I don't know about that one, because I would argue that we are already seeing insane, leaps in portfolio level strategies, and that's been going on since the 80s. And I question how much further LLM models are going to take that. Okay, let's see. So what's the advancement? It's several prerequisites. Major breakthroughs we're about to see are already here, although in a rudimentary state. Those are simply some of the current quantitative models that exist as the advancements we've seen in transformer architecture, and as a consequence, language models. Most people I talk to about GPTs still don't seem to get it. It scales with compute, and there's emergent properties that are completely unexplainable by the researchers that built it. Namely, sentiment analysis was not something these models were trained for, but became world-class at it. Universal aggregator. The second is pairing a language model with advanced search engine. The PayPal mafia quietly took a bet on an AI lab that isn't open AI. It's called Mindy. Yupon, a co-founder of PayPal and employee number one at YouTube, co-founded an AI lab backed by Peter Thiel and Roelof Botha. Effectively, the AI is like if ChatGPT and Google had a baby. It's an AI you just email it. It's an AI you just email, and it has indexed the entire internet and can answer any question about anything. To give an example that would be relevant to this subreddit, it can give you specific financials on stocks instead of doing manual research. It's also used by anyone from retail traders to private equity firms already. Admittedly, I currently use this to expedite my due diligence, and of course, this can be extrapolated to any area of research, but the reason why a tool like this is interesting is because you could hypothetically aggregate all past data with the same underlying technology. Which comes to my third point, modeling the entire stock market. No longer will hedge funds be using pure mathematical models for trading with some macro trends factored in. They will be making their own AI models on the history of the entire stock market using the aforementioned systems. This isn't just quantitative price fluctuations. Firms will create entirely new models where they scrape every piece of news associated with a specific stock index in the global economy and perform sentiment analysis on the exact news released on that historical day and tie its sentiment to the exact stock price on that historical day. I hate to break it to you, buddy, but they've been doing that for 10 years. They've been doing that for 10 years. So this comes to this fundamental misunderstanding that I think people have about the efficient market. So first of all, they think that we think that the market is efficient. Like the general layperson's idea of the market is efficient. All available information is currently factored in, and there are only some narrow cases where that's not true. And ergo, as we discover them and trade on them, those will also be removed from the market, right? That's not how it works. The market is actually fundamentally inefficient. Current prices do not reflect all available information, and informational inefficiency is everywhere and abundant. So much so that it's hard to make money from it because you could be totally right, but then that information still doesn't get priced into the stock. So as we become more efficient, you just get inefficiencies elsewhere. essentially. It's just, you will never have this perfectly efficient market. And in fact, what we've found instead is like we have all of these algorithms already doing all of this stuff. And then when something goes wrong, when there's a recession or whatever, they all go haywire. So there will always be edge out there to be had. Always. Yeah, exactly. Jim Simmons was using some sort of machine learning before 2000. Exactly. I really think so. I think that Renaissance Capital, right? They went through different periods, and I think that the edge that they were finding changed. I think what they did was this. I think that they started with a momentum strategy because they originally started in commodities. That meant that they were doing time series analysis, and they were saying, this thing is going to trend this way. And I'm going to get into, well, we're going to make a video about momentum, but you know, there's triggers and then you get into the momentum. Then what they started doing is they started using machine learning on the momentum strategies to optimize them, right? And one of the big optimizations that they made there was in Markov models. So if you use a Markov model to determine whether we are trending up or trending down or not trending, then you get an even more efficient momentum model, okay? Then what I think they started doing is they started doing multi-time series correlation analysis, right? Deciding which instruments to actually trade in their strategy. Oh, are you guys still there? Because my data just died. Well, we'll see. I pull up Google. My music is still going. Yep, you guys are still talking. I guess it was just rhythmic. Okay. Something's going on my system. I think it's just me. Okay. So it says it reconnected successfully. As that happened, Steam was trying to download something and my virus detector detected it as a virus. Let me finish what I was saying first. Okay. Then what I think Renaissance Capital started doing is they started running this stuff across all of the assets. They said, okay, if the treasuries start to trend down and interest rates start to rise, what will be the impact on all of these other assets? And then what will be the impact on all of those assets? And so now they kind of had this model that says like how all of these different things are going to move in correlation to each other, to the point where it was practically like they were predicting the whole market, right? And that's what I think that they've been doing. So yes, I think that they've kind of been doing this, that Renaissance Capital has kind of been doing this stuff for like decades. And our research is just like only just barely catching up to understanding how that works. By the way, as that happened, it looks like we are finally breaching highs for the day, but it's kind of been nonchalant. There was a big trade there, 6,000 at 21. There is a big iceberg there. Because I'm having connection problems, I'm definitely not going to take a trade now. Let's see what Nod32 is saying. Come on, where is my... Does it pop up over in here? I want to see what it was. How do I see that? Hmm. Ah, here we are. A variant Win64 pack Thermida L suspicious application. I guess I'm just gonna have to hold it here and type it. Oh, so here's some people on Steam saying yeah. Okay, which game was it? Today at 8:19, it might have been Helldivers. This game lapse one, I don't know if I want to do that. Let's try and find the folder. That folder is empty. Oh, but here's an app. What's an ACF file? Are you a bug man or a bot man? What do you mean by that? They're just text files. I mean, that's what I thought, but I wanted to see if there was more to it. Ah. It thinks that there was a Trojan in Helldivers. Okay, so let's go to Reddit. Reddit.com/r/. Divers. The thing though is that it said that it installed the update. Okay, let's see here. Now I'm getting hyper suspicious here, folks. Sort by new. Okay, well, there's only one thing that we can do. We can try loading the game. Oh, are you a bugman or a bot? Yeah. I've been playing the bots more, I would say. So probably isn't the best idea with like having so much stuff open and the stream going, but I'm gonna see if the game loads. Come on. Okay, I clicked on that and nothing's happening. Oh no, wait. Maybe now it's going. Okay, they're coming back to that low of the month at 24. So this might be a spot where they might try and defend it a little bit again. Okay, let's see if it loads. That screen is black. It seems like it's been black for a little bit too long. How long should we give it? I kind of feel like it's already been too long. The institution, somebody's trying to get into all my super secret algorithms on my computer, and I foiled them. Already too long, says BS. I do. gonna go out and back in and see if that does anything. No. End task. I think it started twice actually. I don't know if that was a legit example. Leave this open. Okay, let's play. Do you know any effective one order cancels the other hedging strategies? You know, I prefer to put the stops and targets in myself and adjust them as the market goes based on the current conditions. Anytime that you set a stop and a target that are like set, like a set number of ticks, for instance, that affects the results that you're getting. Like it becomes so dominant in your results that matters more than almost anything else. So really, if it's a lot better to, have something where if you get a winner, well, you let it run and you can really let it run. Still black. I strongly suspect that there is some developer on the Helldivers team inserting Trojans into it and he hasn't been caught yet. Okay. Tells me Helldivers 2 too, and then there's 2. Oh, I guess there's a CRS. Okay, well, whatever. Okay. All right, I will now post. Not 32 detected a variant of Tachypyramida L. In the latest update, Steam says the update completed successfully, but the game never But when I start the game, all I get. Shall we? Is there a way to find out how many orders are canceled? Well, what do you mean by canceled? Like, the order is on, and then you pull it? So, how do I say? So if the number of limit orders at a price goes down without there being a corresponding trade, then you know that it was canceled. Now, algorithmically, that's a little difficult to pull out, right? Because that means that you have to try and correlate every change in level 2 with an order. And depending on the data feed and stuff, it's a little iffy. That's one of the things that one of my algorithms does. The cumulative delta for stocks that I have in my indicator suite, it is trying to match together the market orders that have been seen with the changes in level 2 to better categorize that volume as buy or sell volume. Okay, so like it can be done, but it's a little bit more complicated. Because if you just go in and you just look at decreases in level 2, you know, you're always going to find that the decrease in level 2 strongly correlates with price moving because, you know, that's factoring in cancellations and market orders, essentially, right? Is clearing showing orders at the end of the quarter who bought or sold? I don't know what you mean by that. So the reason we only... So the stuff about like at the end of the quarter, right? We know how those funds operate, and the big banks, they kind of can look at their own order flows and they can see who is who, and they can determine how much money is coming in from that thing. That's why you can go and find analyst reports from like Goldman Sachs and so forth where they estimate how much money has to rebalance. And that's the only way that they know that. We can't sort that out with our data. We can just anticipate that it's going to happen, and then when we see a significant amount of buying or selling that matches up with it, we can try and run with it. So coming back over here to set rules, quarantine, this submit for analysis. What is this, what is this Trojan? The Amida is security software used to protect applications against attempts to reverse engineer them, but historically it seems to have been used to deploy malware too. Google seems to indicate that ESET has a track record of generically flagging Amida regardless of circumstance. So I think this is a false positive. I think that this probably is a false positive. Okay, so I am going to I don't know what I can do. I think that I probably have to redo the update, right? Because there's nothing in that folder. I don't know what to do to be able to play the game again. That's funny. And you know what? By the way, I said that low of the month was at 24. It stopped literally right there. I'd rather be a little bit, I would have rather have sold it right there. I don't think that I would have though. We only got 10 minutes left. Well, sorry for getting so distracted. Well, you know, I was dealing with something important. I tell you what, I'm so paranoid about this sort of stuff, but I think that it was a false alarm. Probably jumped the gun a little bit. Refinitiv or Bloomberg Terminal for trading. So there's a couple of people running around with the Refinitiv thing out there. I don't think that it's really very useful to retail traders. Bloomberg is a different story. Bloomberg has access to so much data. There is some data feeds in Bloomberg that I know of that could explicitly help us trade the treasuries. When I looked for that sort of stuff in Refinitiv, you know, I had the right package and everything, but it just didn't give me the data that I needed. So Refinitiv would probably be useful if you were trading stocks, perhaps. There's a way to get like a cheaper version of Refinitiv. Bloomberg Terminal though is super expensive, so. Here's somebody finding it on. Oh, I found more. It is a kernel level anti. I'm really not a fan of this kernel level. We're going to restore the file. But since it was in the download, it's like it's going to be there and the game's not going to do anything with it, right? And come back to Steam. Steam apps. Downloading, right? Data. Game. There's the game, right? It's not doing anything. So I probably have to come into Steam and tell it to do something like tell it that the files are Probably need to do that after the stream. Verify integrity is probably all we can do. That or uninstall and reinstall. Is it even possible to trade on Bloomberg Terminal or Refinitiv? I know Refinitiv. So they provide data. You don't necessarily trade with them. Like, you don't execute with them, but you sit there and you get the information from that and you use that to inform your trade. So, to be specific, like if you worked at a bank, what you would probably do is you would have Bloomberg running, and Bloomberg would be giving you information like the price of certain bonds on certain exchanges, right? You then take that information, and they have a plugin that puts it into a spreadsheet. And then you have all of these complex computations that are going on in the spreadsheet that will spit out some other number to you. And you might use that other number to as like the price to use over on a different instrument or something like that, for instance, and you would trade off of that valuation. So that's how these professional traders use things like Bloomberg. And I bet you that, like, if you went to the treasury desk at Goldman, for instance, that, and you know, we're talking to them and they were showing you all the stuff that they knew, they would probably be showing you some of their Excel spreadsheets that they use for their trading. Heard the majority of Bloomberg terminal traders use interactive brokers. Oh, I don't know about that. Yeah, so if you are like running your own fund, I'm not sure that you would go to interactive brokers. I mean, maybe you could. But there are a lot of offerings out there that are geared specifically towards funds. So, for instance, when I worked for Goldman, they had a platform called Ready Plus, which was a platform geared specifically towards these funds and so forth that were trading with them. Ready Plus was eventually spun off into its own entity, but it's still something you could get. And if I was trading as a large fund, like if I had, you know, $1 billion under management or something like that, I would probably be looking seriously at using Ready Plus, for instance. It's one of the options at the very least. Right. Interactive brokers, what kind of is unique about interactive brokers is that they are a broker that allows you to do futures and stocks and options and all of that on a pretty open platform, right? So there's like Thinkorswim and interactive brokers, and interactive brokers is kind of more of the highly technical, like you can kind of screw around with your setup sort of version. So yeah, if you're a retail trader, there might, you know, you're doing a lot of different things, there actually is a pretty good chance that you would end up at interactive brokers. But there's lots of things about interactive brokers that people don't like too. So they're testing those highs again. I'm kind of tempted to short it, but you know, it's already too late. So I don't like taking a trade like that. I'd be too worried about them busting 24 and then coming back, you know? Well, anyways, today's stream, we should give it a name. Rates Carnage continues for the second day. Continues overnight. For retail in Europe, the only actual real broker is Interactive. Really? I know a lot of people from my reading on the internet, because I've never used them, but I have downloaded their platform and tried it once, but I know that a lot of people have a love-hate relationship with Interactive Brokers. All right, guys. I'm going to get going. I will see you tomorrow. We still got plenty of big stuff going on this week, right? So see you then. Stay excellent, team.